Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss about the RBI notifications for the month of January 2022. RBI notification for the month of January 2022. We are planning to conduct Indian Overseas Bank special classes for scale 3 to 4 and 4 to 5 shortly, exclusively for scale 3 to 4 and 4 to 5. And we are also planning to start in the March 2022 first week JAIIB and CAIIB online classes for June 2022 examinations. Framework for facilitating small value digital payments in offline mode. Framework for facilitating small value digital payments in offline mode. Offline payments may be made, number one, offline payments may be made by using any channel or instrument like cards, wallets, mobile devices, etc. Number two, offline payment shall be made in proximity, face-to-face mode only. This is always face-to-face mode. Third one is, offline payment transactions may be offered without any additional factor authentication. Offline mode without any additional factor authentication. Point number 4, the upper limit of offline payment transaction shall be 200 rupees. Upper limit of offline payment transaction shall be 200 rupees. The total limit for offline transaction on a payment instrument, 2000 rupees. Upper limit of offline payment transaction shall be 200 and the total limit for offline on that instrument is 2000 at any point of time. Replenishment of used limit shall be allowed only online mode. This is about the framework for facilitating small value digital payments in offline mode. RBI notification dated 3rd January 2022. RBI Retail Direct Scheme, retailing of Government of India SLR securities, market making. Market making means for creating market in the instrument, secondary market in the instruments, RBI was given permission to primary dealers. You will see what it is. Providing one-stop access to facilitate investment in government securities by retail investors. That is the object of retailing direct scheme in Government of India securities by retail investors. In this connection, to provide liquidity, two-way liquidity in the secondary market in the Government of India securities, a market making arrangement. Market making means when the investors are selling, the market maker has to buy. When the investors are buying, the market maker sell. This is the market making two-way. They have to act two-way, wherein the primary dealers shall be present on NDS OM platform. Normally, all Government of India securities are traded on negotiated dealing system order matching operated by CCL, Clearing Corporation of India. So, the primary dealers are available during the trading time in the NDS OM. Normally, morning 9 to evening 5 throughout the market hours and respond to buy sell request from the retail direct gilt account holders, means retail investors. Retail direct gilt account holders, abbreviation. Retail direct gilt account holders. It means to improve the liquidity, primary dealers are appointed as market makers in Government of India securities. It is going to be traded in negotiated dealing system order matching system platform operated by CCL. They are available, primary dealers are available throughout the market hours. This is a very useful circular, important circular. Master circular, bank finance to NBFCs. After a long period, RBI has given this circular. RBI notification dated 5th January 2022. Point number 1. Banks may formulate suitable loan policy with the approval of it. Whenever there is an NBFC, suitable board approved policy regarding prudential guidelines and exposure norm to NBFCs within the limits prescribed by whatever the board directions are there, that must be within the norms prescribed by. Number 2, bank should not grant any bridge loan of any nature. Bridge loan means against temporary receivables, against public issue, against long-term loans from financial institutions. Against that, bank should not grant bridge loan to NBFCs. This is the thing. Third one, bank exposure to single NBFC, single non-banking financial company, excluding gold loan companies, will be restricted to 20% of their eligible capital base. That is called Tier 1 capital. Bank exposure to single NBFC, 20% of Tier 1 capital. Group, 25% of Tier 1 capital. Bank exposure to single NBFC 20, group 25%. Fourth point, the exposure of a bank to a single NBFC which is predominantly engaged in lending to against gold jewelry, collateral of gold loan jewelry, these gold finance companies. It means such loans, gold loans comprising 50% more of their total assets, gold loans are there. For that, the exposure norm is not exceeding 7.5% of banks Tier 1 and Tier 2 capital. For gold loan companies, gold loan NBFCs, maximum exposure not exceeding 7.5% of banks capital funds, that is Tier 1 capital plus Tier 2 capital. This is about gold jewelry finance companies. Fourth point. Fifth point. However, this exposure ceiling means 7.5 may go up by another 5% if they are dealing with infrastructure sector. Gold jewelry finance companies, they are also dealing with infrastructure companies, infrastructure finance. It can go 7.5 plus 5%, that is up to 12.5% of capital fund Tier 1 and Tier 2. This is gold finance companies plus infrastructure 12.5. Only gold jewelry finance companies 7.5% of Tier 1 and Tier 2. Sixth point, banks may also consider fixing internal limits for their aggregate exposure to all NBFCs. This is the new point. Now in the coming days, banks will come up with a policy. They will restrict what is their total exposure to NBFCs. Banks may also consider fixing internal limits for their aggregate exposure to NBFCs, all NBFCs. That is. Seventh point, very useful. Infusion of eligible capital funds after publication of balance sheet 31st March. Infusion of capital after publication of 31st March may also be taken into account for the exposure norms purpose, subject to sealing with external audit certificate. At that time, they have to take a certificate from the external auditor of the bank. So, infusion of eligible capital funds after the published balance sheet date may also be taken into account for the purpose of computing exposure norms Tier 1 and Tier 2. Eighth point, banks should not invest in zero coupon bonds. Banks should not invest the zero coupon bonds issued by non-banking financial companies unless the issuing NBFC builds up sinking fund for all accrued interest on the zero coupon bonds. Whatever the yearly accrued interest is there, that they have to create a sinking fund at least to the extent of accrued interest on assumption basis and keeps it invested in liquid securities and Government of India bonds. Unless this condition is not there, banks are not allowed to invest in this. Banks should not invest in zero coupon bonds issued by NBFCs unless the issuer NBFC company builds up sinking fund for all year-wise accrued interest on the zero coupon bonds on the assumption basis and keeps it invested in liquid investments or securities Government of India bonds. These are the guidelines of RBI regarding Master Circular NBFC. Now, Basel III framework on liquidity standards or liquidity coverage. Basel III framework for liquidity standards. There are two liquidity standards are there. One is liquidity coverage ratio. The other one is net stable funding ratio calculation. For liquidity coverage ratio and net stable funding ratio calculations, they are issued a little bit separate guidelines. What is this? This circular is applicable to all commercial banks other than RRB, local area banks and payment banks. This is applicable to commercial banks other than RRB, local area and payment banks. Third point, with the objective to better align our guidelines, means our Reserve Bank of India guidelines, Indian Bank guidelines with the BCBS, Basel Committee on Banking Supervision standard and enable banks to manage liquidity risk more effectively. With a view to effective management of liquidity risk through liquidity standards. What are the liquidity standards? Liquidity coverage ratio and net stable funding ratio. Liquidity coverage ratio 1 to 30 calendar days. Net stable funding ratio liquidity management up to 1 year. It has been decided to increase the threshold limit for deposits and any other extensions of funds made by non-financial. Non-financial means we can say retail. Other than financial institutions, so non-financial. Small business customers means retail customers. It has to increase the threshold limit to 7.5 crores. Earlier the limit is 5 crores. Now the limit was increased to 7.5 crores for the purpose of maintenance of liquidity coverage ratio and net stable funding ratio. For non-financial, it has been decided to increase the threshold limit for deposits and other extensions of funds made by non-financial retail customers, small business customers up to 7.5 crores. For the purpose of LCR and NFCR, non-financial small business customer deposits up to increase it to 7.5 from 5 crores. This is the latest amendment. Registration of assignment of receivables, Reserve Bank of India Regulation 2022. This is where any trade receivables are financed through TREDS, Trade Receivables Discounting System. Now, as of today, the MSME units are discounting almost all their bills with the TREDS, Trade Receivable Discounting System. The concerned TREDS means TREDS exchange. The concerned TREDS exchange on behalf of the factoring company shall within a period of 10 days from the date of such assignment. From the date of that assignment within 10 days they have to register with the central registry or even after satisfaction also they have to inform to central registry within 10 days. This is registration of assignment with central registry at the time of discounting the bill or at the time of realization of the bill. Satisfaction means realization, payment of the bill. Both times within 10 days, the concerned TREDS exchange, they have to register with the central registry. Registration of factors means factoring company. Factors means factoring. This is also one type of factoring means NBFC. They will purchase the bills discounting from the various companies. Registration of factors. Net owned funds of 5 crores are as specified by the Reserve Bank of India from time. For registration of for getting license of factoring company, net owned funds requirement is 5 crores. They have to take certificate of registration as NBFC factoring company from RBI. One is net worth 5 crores, registration for RBI from this. Now, third point is the principal business criteria, PBC, principal business criteria for factoring companies. NBFC factor. What is the main business criteria? Shall ensure that its financial assets, out of its total assets, factoring business assets constitute at least 50% of the total assets. If a factoring company having total assets, out of total assets, at least 50% of the assets from factoring business related, and its income, its P&L, its income account derived from the factoring business is not less than 50% of its gross income. So total assets, out of total assets, not less than 50% of the assets from factoring business, out of total income, gross total income, minimum 50% of the income from factoring business. This is the main definition for the factoring company. What is the object of factoring? These factoring agencies, these factoring companies are discounting or purchasing the receivables with the from various customers either with recourse basis or without recourse basis. The factoring transactions are going to improve the liquidity of the organizations considerably. Dear viewers, thank you very much for extending support to our YouTube channel. Thank you very much for all.